Did you know there are 15 simple rules that can triple your low salary in just 3 months? Sounds incredible, right? These rules are easy to apply and have been proven by someone who started from scratch and is now a billionaire. If you're earning a low salary right now, these secret tips can help you use your money more wisely and see it grow quickly. They help you avoid common mistakes that hinder you from multiplying your money and have already transformed the lives of thousands of people around the world. Stay until the end of the video, because if you don't follow all the rules, your financial life won't improve and might even get worse. Let's start with the first rule: know your living costs. To control your money, you need to know exactly where it goes. This means understanding all your expenses, from big ones like rent and food to small ones like your daily coffee. First, write down all your monthly expenses, such as housing, food, transportation, health, leisure, and personal expenses. Then, add them up to get a clear picture of the total cost of your lifestyle. Do this for at least 3 months to get a more accurate average. Knowing exactly how much it costs to live is the first step to taking control of your finances. Let's move to the second step, but before we do, make sure you're subscribed to the channel because here I'm going to unlock the secrets of the rich and reveal everything to you. Now, the second step: don't spend more than you earn. Think of your money like a bucket of water. If you take out more water than you put in, it will dry up quickly. Similarly, if you spend more money than you earn, you'll end up with nothing and might even accumulate debt. Suppose you earn $3,000 a month. This means you should plan your expenses to never exceed that amount. If you spend more than you earn, like $3,500, that extra $500 has to come from somewhere, usually a loan or credit card, which creates debt. And debt has a snowball effect. It starts small but can quickly grow and become a serious problem. If you're spending more than you earn, it's time to make adjustments. Maybe cook more at home instead of eating out or cancel services you don't use much. Always plan your expenses and make sure they never exceed your income. This might mean making tough choices, like delaying non-essential purchases or finding cheaper alternatives. But this discipline is crucial to maintaining your financial health and avoiding bigger problems in the future. And if you're married, you can avoid problems by following the third rule: keep separate bank accounts. Even if you're married, it's a good practice to keep separate bank accounts for your personal finances. This doesn't mean you don't trust your partner, but rather that each person should be responsible for their own money and expenses. Having separate accounts helps maintain financial clarity and makes it easier to track how much each person is earning and spending. For example, you can have a joint account for shared expenses like rent, bills, and groceries, but also individual accounts for personal spending. This avoids confusion and conflicts over how money is being spent. Additionally, if one of you has different spending habits or less financial control, keeping separate accounts can protect the other from potential financial issues. Comment below if you've ever had problems in your marriage because of a joint bank account. If so, separate your accounts and allow both of you to maintain financial independence, which is healthy for any relationship. This way, you can discuss and plan shared finances together while still maintaining individual control over your own finances. Now, if someone close to you doesn't have financial control, the fourth rule will surprise you. Avoid people with financial problems. Keeping your distance from people with financial problems may seem harsh, but it's an important step to protect your own finances. When you get involved with people who have trouble managing money, there's a high risk that their financial problems will end up affecting you too. For example, if you have a friend who is always borrowing money and never pays it back, that situation can become a burden. Comment below if you have people like this in your life and how you deal with it. These people with financial problems often have irresponsible spending habits, and being around them can negatively influence your own financial decisions. This doesn't mean you should abandon friends or family in need, but you should set clear boundaries. To do this, put the fifth rule into practice: never lend money. Lending money to friends or family may seem like a good deed, but it often creates problems. You are not a bank, and when you lend money, there is a high chance you won't get it back, which can harm your own finances. Moreover, lending money does not solve others' financial problems sustainably. Instead, they may end up depending on you rather than finding solutions to their own difficulties. So, focus on taking care of your finances and your family. If someone asks to borrow money, it's better to offer emotional support or financial advice. Help in ways that don't compromise your own financial security. Another thing that can put your financial life at risk is covered in the next rule. But before we talk about it, I noticed you haven't liked the video yet. This is very important to help this video reach more people. So, help spread the knowledge and let's continue. The sixth rule is, never gamble with your money. Avoid using your money on bets or gambling, like casinos, lotteries, or even risky investments like cryptocurrencies and speculative stocks. Luck might favor you once in a while, but most of the time, you'll end up losing. When you gamble with your money, you are putting your finances at risk. It's like flipping a coin and hoping it always lands on the right side. This is very risky and can make you lose everything you worked hard to earn. Think about all the hours you worked hard to earn that money. Imagine using all that effort on a bet and suddenly seeing it disappear. Comment below if this has ever happened to you and how you felt. Additionally, gambling can become a dangerous habit. The thrill of winning can make you want to keep betting, even when losses start to pile up. Many people fall into the trap of trying to win back lost money by betting even more, which almost always leads to bigger losses. This can create serious financial problems and huge debts. To prevent this from happening, you need to know the seventh rule. Spend your money on things that give you money back. When you think about where to put your money, it's important to choose investments that pay you regularly. Instead of spending on things that don't bring returns, like a house or a new car, invest in something that generates continuous income. For example, buying a rental property or investing in a profitable business are great options. These investments not only keep your money safe, but also increase your monthly income. Unlike owning a house, which only creates expenses, a rental property gives you a return every month. When you invest in something that pays you regularly, your money starts working for you, creating extra income. And speaking of extra income, investing in knowledge and courses can also be an excellent way to boost your earnings. Learning new skills can help you get better jobs and make more money. To help you with this, did you know there's a 7-second brainwave ritual that anyone can do to attract money? Check the link in the video description or in the pinned comment to learn more. So, when thinking about where to invest your money, remember to also invest in yourself. The knowledge and skills you acquire can be one of the most valuable returns in your financial life. And if you have kids, teach them this too. Because the next rule is, don't give your kids an allowance, teach them to work for it. Instead of simply giving your kids money as an allowance, encourage them to work for it. This teaches the value of work and helps develop financial skills early on. For example, instead of giving them $10 a week, offer tasks they can do to earn that money, like helping with household chores, gardening, or doing small jobs. Besides learning to earn money, they also learn to manage and value what they receive. This practice not only prepares them for adult life, where they will have to earn and manage their own money, but also teaches them responsibility and discipline. You can even open a savings account for them, where part of the money they earn is saved for the future. This helps them understand the importance of saving and investing from an early age and will make a big difference in how they handle finances in the future. A good example you can set for them is practicing the ninth rule. Always pay your credit card bills on time. Let's imagine you made several purchases throughout the month and now the bill has arrived. The rule is simple. Don't put it off, pay it all at once. This avoids high interest rates, which can turn a simple purchase into a huge debt. Using a credit card responsibly is a great way to keep your finances organized. It helps you track your spending, as you can see exactly where your money is going. But the key to this working is always paying the full bill at the end of the month. Moreover, by following this rule, you're setting a great example for your kids. They see how you handle money and learn the importance of being financially responsible. This is crucial so that, in the future, they don't become irresponsible and indebted adults. And one mistake that leaves many adults in debt is not following the next rule. But before we talk about it, make sure you're subscribed to the channel because I will continue revealing the secrets of the rich and tell you everything in the next videos. Let's move to the 10th rule, rent instead of buying. When you're starting to build your wealth, it's better to rent instead of buying. This applies to housing, cars, and other expensive items. Renting keeps your expenses flexible and prevents you from getting stuck with big debts. For example, instead of buying a house with a 30-year mortgage, you can rent an apartment. This allows you to save money and invest in things that generate income. Similarly, instead of buying a new car, consider renting or leasing. This avoids the high costs of maintenance and depreciation of owning a car. Big companies do this all the time. Many banks and large corporations prefer to rent their offices rather than buy. They do this because they know it's financially smarter and keeps their capital free for other investments. So, until you have a substantial amount of money, prefer to rent instead of buy. And if you're going to buy something, keep the following rule in mind. Stop buying liabilities and start acquiring assets. Instead of spending your money on things that don't bring a return, like brand name clothes, expensive electronics, or luxury items, start investing in things that can generate income and grow in value. An asset is something that puts money in your pocket, while a liability is something that takes money out of your pocket. For example, instead of buying the newest smartphone that will soon become outdated, think about investing in stocks, real estate, or a business. These investments can increase in value over time and give you extra income. When you invest in assets, you are building a solid financial foundation for the future. Imagine buying a rental property where you receive rent every month. This is an asset that continues to give you money, unlike a new car that only loses value and costs a lot to maintain. So, the next time you think about spending money, ask yourself, is this an asset or a liability? Prioritize acquiring assets that can help you grow financially. Additionally, before buying anything, you need to think about the 12th rule. Don't buy if you can't deduct it on your taxes. Let's simplify. Only buy things that can help you pay less tax. This means that if you can't deduct the purchase on your income tax, it's better not to buy it. Why? Because you want to use your money wisely. For example, some things you buy for work, health, or education can be deducted on your taxes. This means the government gives you a discount for buying these things. So, if you buy something that can't be deducted, you're spending money without that extra benefit. Before buying anything, think about whether you can deduct it on your taxes. If you can't, it might be better to save the money or invest in something that brings this benefit. It's a simple way to ensure every purchase is a good deal for your finances. And to manage your finances even better, the next rule is to limit your spending to your passive income. But what does that mean? Extra expenses, like trips, dining out, and luxury purchases, should only be made with the money you earn without having to work, that is, your passive income. This money comes from investments, like rental properties, stock dividends, or savings interest. Think of it this way. Use your salary to pay for basic needs like housing, food, and transportation. For those extra things, like a new gadget or a trip, use only the money your investments are generating. This ensures you don't spend more than you can and helps you save more of your salary to invest and increase your passive income. For example, if you have investments that earn you $500 a month, use that amount for your extra expenses. This way, you keep your finances balanced and still enjoy the good things in life without compromising your financial security. Another thing you need to do to protect your finances is to follow the rule of never mixing your personal and business accounts. If you have a business, keeping personal and business finances separate is essential for good financial management. When you mix these accounts, it's hard to know exactly how much money your business is making or losing, and it can end up causing financial problems for both you and the company. For example, if you use business money to pay personal bills, like rent or groceries, you won't have a clear view of your business's real profits and expenses. This can lead to bad financial decisions and hinder the growth of your business. To avoid this, open a separate bank account for your business and use that account exclusively for business transactions. Pay yourself a salary from the business account to your personal account and use that salary for your personal expenses. Keeping finances separate helps you better organize your accounts, makes accounting easier, and gives you a clearer view of your business's financial health. Additionally, in case of an audit, it will be much easier to show accurate financial records. And the last rule is not to do business with people who don't share their finances. Before investing in a business or project with someone, it's crucial to have a clear view of that person's or company's finances. If someone is not willing to share details about their personal or business finances, that's a red flag. For example, imagine you want to invest in a new venture with a partner. If this partner is not willing to show their bank statements, financial reports, or credit history, you have no way of knowing if they are financially responsible. This can lead to unpleasant surprises in the future, like hidden debts or poor financial management. Financial transparency is crucial for any successful business partnership. Knowing exactly how your partner's financial health is gives you confidence that the business is in good hands and that your investment is safe. So, before closing any deal, make sure all parties involved are willing to share their finances openly and honestly. If someone refuses to do so, it's better to find another partner. Remember, applying all these tips can transform your financial life. Be disciplined, make smart choices, and stay focused on your goals. If you follow these rules, you will see your money grow quickly and safely. To help you accelerate this, watch the next video to continue discovering the secrets of the rich, and don't forget to subscribe to the channel.